This is Bite Size Business, the channel where we use financial metrics and ratios to gauge the financial health of a company. Today we will start a new series on shipping companies. Going into the holiday season, we will take a look at the companies, making sure everyone's presents get to them on time. On today's menu we have UPS. UPS was founded in 1907 in Seattle, Washington as the United Parcel Service, and has been shipping packages for so long that their first dedicated delivery vehicle was a 1913 Model T Ford. UPS was a pioneer in air freight services starting in 1929 and resuming it in 1953 after recovering from the Great Depression, riding the U.S. economic growth after the two world wars. In recent news, UPS granted some of the largest union wages in the world, granting drivers pay benefits totaling around $170,000 a year. In the months following this deal, UPS announced that it would lay off 12,000 workers and mandate staff return to office 5 days a week following a poor 2023 financial performance. Taking a look at the starters, we can take a look at the income statement. In the last 12 months, UPS has done over $90 billion of revenue, paired with $11.8 billion in EBITDA and $5.7 billion of net income. Off to the balance sheet, we can see that in the last quarter that UPS reported assets, they had $68.26 billion of assets, paired with $51.4 billion of liabilities, with this consisting of $26.25 billion of debt. This leaves us with a total equity of $16.88 billion. Finally, looking at the free cash flow statement, we can see in the last 12 months, UPS had free cash flow of $4.35 billion. This is from $9.2 billion in operating cash flow. And this number is reduced by the $5.4 billion the company did in dividends and the $500 million they paid in stock buybacks. Now off to the main course. One thing that we need to take into consideration when looking at some of these numbers is the US economy slowed its growth rate since COVID as the stimulus kind of dried out. And so that has affected a lot of the numbers out of UPS as they are a company that does really well when the US is growing at a quick rate. That being said, let's get into the meat and potatoes of this meal. Today's company was UPS, or the United Parcel Service, who trades under the ticker symbol UPS. They're in the shipping industry and in the last 12 months did $90 billion of revenue. This is about the same as their 2023 numbers, and it is down significantly from their 2022 numbers of over $100 billion of revenue. One thing that should be said about this number is in some of the findings I found when researching for this video, it is estimated that UPS ships upward of 6% of the US GDP, which that is a huge number when you take into consideration the US GDP is around $30 trillion, meaning that UPS probably ships around $2 trillion of goods a year. UPS's EBITDA in the last 12 months was $11.8 billion, down from $12.7 billion in 2023 and down sharply from its 2022 numbers of $18.7 billion. We see this trend continue in their net income, which came in at $5.7 billion, down from $6.7 the year before and $11.5 in 2022. Total debt is sitting at $26.24 billion, total assets at $68.26 billion, and liabilities at $51.37 billion. This leaves us with a shareholder equity of $16.9 billion. Free cash flow in the last 12 months stood at $4.3 billion, down from $5 billion in 2023, which is around half of what it was in 2022, coming in at $9.3 billion. Buybacks have taken a little bit of a dip, seeing that the free cash flow dropped so significantly. Buybacks came in at $500 million in the last 12 months, which was down from $2.25 billion in 2023 and $3.5 billion in 2022. The dividend has not fallen, as the company does raise its dividend every year. In the last 12 months, they paid a dividend of $5.4 billion. In 2023, they paid $5.37 billion. In 2022, they paid $5.1 billion. We can see that their dividend growth has shrunk significantly, though, because they only paid out $15 million more in 2024, or at least the last 12 months, as they did in 2023. Looking at the ratios, we can see the ratios are actually pretty good for a company that's seen such significant earnings drop. Their debt to equity is 1.55. Their debt to EBITDA is 2.23. They have a healthy EBITDA margin at 13% and a lower net profit margin at 6%. Buybacks as a percentage of free cash flow came in at 11%, but buybacks were down in the last 12 months, and as a percentage of net income came in at 9%. Their CAGR for revenue was negative 5%, as revenue did drop by $10 billion in the last 2 years. EBITDA dropped more significantly, down 21% year over year, and free cash flow at minus 32% CAGR, which is not good. They are shrinking at a relatively significant rate, but they do project to be closer to those 2022 numbers in their 2025 fiscal year. Looking at the comparisons, we don't have any other companies to compare it to now, but their debt to equity is high, coming in at that over 1.5 range, but they are pretty close, sitting at 1.55. They have a neutral debt to EBITDA rate, which that's the most important metric on this, because that is just how long it would take them based on their gross earnings to pay down their debt. Taking a look at their EBITDA margin, it is neutral, and their net profit margin is low. That's not really the worst thing. They are in a low margin business, and so I assume that neutral EBITDA margin and low net profit margin will likely stick, although they are on the brink of that middling net profit margin, as they did come in right around 6%, and we're looking at 7% to be in that neutral range. They did return the most capital back to shareholders as of the companies we have thus far, saying that they are the only company we have thus far. Based on these numbers, it's kind of conflicting what I should give them, as the high debt to equity and neutral debt to EBITDA could lean more towards a yellow light, especially with the shrinking earnings. But that being said, the company was in such good financial health while they were making so much money that I kind of have to give them a green light. Because when you look at a company that is still doing well on a debt to EBITDA within the last 12 months, it's kind of crazy to think how well they were doing 2 years ago. Looking back at some of the yearly stats, we can see that the company has total debt of $26.2 billion. If we compare that to their EBITDA from just 2022, they're sitting at a ratio of around 1.5. And if we go back to the comparisons tab, 1.5 would be like very, very low, because our range for low is 2 for our debt to EBITDA. And so the fact that they've managed to stay within a healthy range while seeing their EBITDA get cut in a third is pretty significant. And so that speaks volumes for the standard that UPS holds themselves to from a capital ranking for their debt to EBITDA. Taking a look at the dessert section, which is always sweeter if you are a shareholder of the company. I, for one, am a shareholder of UPS. I bought some more recently because the stock has dropped a lot. And actually, within the last week, I was paid, I believe it was $82 in the quarterly dividend. So I am actually seeing some of the results from this. And it shows that doing the research can help you make some investment decisions if you do choose to trade stock. The total buybacks this company's done in the last 3 years were $6.25 billion. Buybacks as a percentage of free cash flow within the last year were 11%, and as a percentage of net income came in at 9%. Their dividends are much higher, coming in at $15.9 billion. Their dividend as a percentage of free cash flow was 124%, and as a percentage of net income was 95%. We do have to remember, specifically for this free cash flow number, free cash flow is a metric that is given to us after the dividend is paid. And so the operating cash flow was sitting around like $10 billion, but after the dividend was paid, their free cash flow was around $4.5 billion for the last 12 months. Their total distribution within the last 3 years was $22 billion. This ratio to their total distribution to their EBITDA over the last 3 years of 51% does seem quite high, But we do have to remember that their EBITDA just 2 years ago was over $18 billion. And so the reason that's so high is because of the earnings drop that we've seen. And assuming that can come back within the coming years, we're looking at a company that still is in good financial health, paying out a strong portion of their cash flow. Um, that being said, that does kind of lead us to the check. And I will start that by kind of looking back at the yearly stats. While I am optimistic about the future of this company and their ability to grow their earnings, we do have to mention that their EBITDA did drop from 18.7 to 11.7 billion dollars. That's a drop of $7 billion, and that is pretty significant. Um, a large portion of that was fuel costs did rise during that, and this is a fuel-intensive business. That being said, though, that is something we need to worry about. They did do that huge labor union deal, and that is also going to affect their profitability a lot because when you start paying your drivers $170,000 a year with benefits, that's really going to affect the bottom line. And while I do believe companies should take care of their employees, when it comes to a shareholder perspective, that will likely create some negative value for us. Um, as we can see, their revenue did drop by $10 billion over the last 2 years, which that's another issue. The interesting thing to me is their revenue dropped by about 10% or so from 2022 to 2024, or at least the last 12 months. Um, but their EBITDA dropped by like 30%. It dropped by $6 billion or $7 billion, and so a large part of their profitability was coming in some of that revenue. It appears that they lost, which may not be the best thing. One thing I do want to mention is that about 13% of UPS's revenue comes from Amazon, and so they are really exposed to that e-commerce space. And so if Amazon does try to distance themselves and go more into their fully Amazon logistics, that could be another issue for UPS. All that being said, I still am optimistic about the future of this company because they are trying to turn things around, and they did do those layoffs of 12,000 people to try to lower their SG&A costs and increase profit.